Well, after the Fed remained firmly in wait and see mode at their policy decision last week, and the Bank of England confused almost everyone while delivering a 25 basis point rate cut, the new trading week starts on a much more positive note as the US and China roll back their tariffs in very significant fashion indeed, igniting a fierce equity market rally on both sides of the Atlantic and allowing the dollar to rebound too as treasuries sell off across the curve ahead of this week's key US CPI and retail sales reports. Plenty as always for myself and Ryan Littlestone to discuss on the trade-off this week. So without further ado, let's crack on with the show. So it's been a hectic start to the week for financial markets amid news of tariffs being rolled back between the United States and China after the trade talks in Geneva over the weekend. We'll get our teeth into that momentarily, but joining me, as always, to try and make sense of that and everything else that's going on is Ryan Littlestone from Forex Flow Live and Forex Analytics. And my good friend Ryan is very happy this afternoon after West Ham trumped Manchester United yesterday afternoon.
Yeah, for once I'm smiling after a weekend of football, unlike your good self, who's bricking it that you might finish third in a two-horse race.
Yes, I think I've backed a donkey this year, let's put it that way, and that donkey has managed to fall out of the Champions League as well. But yeah, the less said about football, the better. I think I'm going to impose my own tariff on any mention of the beautiful game between now and the end of the season. There you go. A Mike Brown executive order has been handed down.
Yeah, I'm going to break that tariff if we win next week.
Oh, I bet you will. Right, well, let's crack on with the show because we do have absolutely tons to discuss this week. Right, trade, tariffs. Let's go again onto that bandwagon. What a complete waste of time the last 40 odd days have been. It's like it was all a bad dream, to be completely honest with you. You'll remember, of course, Liberation Day on the 2nd of April and the various tariff increases that we had since. Well, the US and China finally sat around a table in Geneva over the weekend. And I'll be completely honest with you, the outcome from those trade talks is firstly much more concrete and secondly much more positive than certainly I had envisaged, and also I would imagine most other market participants had envisaged as well. Significant tariff cuts forthcoming on both sides. China lowering their tariff on US goods to 10% from 125%. The US lowering its tariff on Chinese goods to 30% from the prior 145%. That's a 10% reciprocal tariff and 20% that's ostensibly in place due to the supply of fentanyl coming into the country. Both of these rollbacks will take effect by the 14th of May, so this Wednesday, and both will be in effect for 90 days. Although it's worth noting that the market is very much taking 90 days as forever, because I think it's pretty obvious at this point that tariffs at such a high level where you've got an effective trade embargo between the two sides are really not desirable. And actually it's quite clear now that neither side, particularly the US side, actually has the ability or the desire to stomach the economic pain that those tariffs would cause. When those tariff rollbacks go into effect, the US and China have also agreed to continue trade and economic talks over the next few weeks, presumably with the aim of reaching a more concrete trade agreement at some point in the future, although Treasury Secretary Scott Bessent has said that the 10% levy is a floor and not a ceiling in terms of how low those tariffs may go. Just to recap where we've been over the last sort of 6 weeks or so, I mean, it has felt like a bit of a bad dream, to be completely honest. We went from negligible tariffs on China to 10%, then 20%, then 54%, then 104%, then 145%. Now we're back at 30%, at least for the next 90 days. And apparently that's a win. If anyone can spin that one for me, then do let me know. But that is generally the vibe that we're getting from markets where we've obviously seen this massive risk rally ignited. S&P futures up by well over 3%, the NASDAQ up by 4%, the dollar north of 101, Treasury selling off across the curve. Certainly the market is taking this in a very, very positive vein indeed. Now, there are a few questions on the whole trade issue still. I mean, we don't know what damage the tariffs that were in place have caused. That will, of course, only become clear in the fullness of time, whether that be in terms of economic data or in terms of supply chain issues. And we also have various question marks over other trade deals. The supposedly easy deal with Japan has not materialized. And also, we don't really know what's going on between the US and the EU. But I do think it feels safe enough at this point to say that we've passed the point of peak uncertainty when it comes to tariff. We've passed that sort of peak noise on the trade front. And I think it also feels relatively safe to argue that, contrary to what I've been saying for quite some time now, the path of least resistance for risk assets is probably tilting to the upside once more, at least over the short term. And I'd argue the same for the dollar.
Yeah, I think so. And this is something that I spoke about on the show last week, and I've been saying for a couple of weeks that, peak pessimism indeed. The market had stopped going down, the dollar had stopped going down, stocks had stopped going down. It priced in all this bad news, and it needed another catalyst to keep going. And if that doesn't happen, there's only one way the price can go. Now, what we've had is a bit of a shift in that direction as well, with all this good news, because the market's saying, okay, well, we've stopped going down on bad news, we're ready to go up, we just need a catalyst on that side. And they got that this weekend. But once again, we have not got a single piece of paper with a signed signature on it from both parties saying this is a trade deal, rubber stamped, off we go. So we're still in this negotiating period. But it's been Trump's plan all along, to get these deals going. It's not to have tariffs in place for the rest of his days, for his tenure as presidency. It's to get deals done and get a potentially better deal for the US.
Which this is out, by the way. This just plainly is not. There were
exactly.
This iPhone would have cost $1,000, but you can't see it. There you go. It would have cost $1,000 at the start of the year. Now it's going to cost, if the full tariff is passed on, 1,300 quid. But because it's not going to cost $2,500, apparently that's a better deal for the US consumer.
Absolutely. Yes, you should claim that as a win, mate. But funny enough, Apple has said they're putting their prices up again just today. So it might not even be 1,300 quid by the time we finish this show. But yeah, I mean, again, that's still not the end game. Tariffs may still come down to 0, less than 10% or whatever. That's all the thing we'll see probably if we get the final UK plan, which seems to be at the front of the queue. So, we're not done yet, and it's all going to wash out. And you've just got to think of the end game, which was, in Trump's political terms, to get what seems a better deal for the US. And if he achieves that, then the market's not going to care if there's 10% tariffs, 5% tariffs, or 20% tariffs on it. It just wants to know that there's not going to be any more blockades in trade, global trade, and everyone else can get on with it. But I mean, I'm looking at the euro because a lot of people are obviously going to think, yes, we've got this big risk rally. How far is it going to go? And the dollar is getting bought up quite significantly. I had my big zone 112, 115. We broke the bottom end of that at 112. Now we're looking lower. But does it mean we're going all the way back to 108, 105? Anything like that? I don't think so. I think there's enough in the mix going on elsewhere with the data, inflation, central banks to maybe see this not dipping too far. Area I'm looking at is around that 38.2 fib, around the 110.40 area. It's a bit of a prior level. We've got the 110, another big level just below that. We've got the 55 DMA right in the middle of that as well. So if you're looking for places to try and counter a move, which I'm not advising while we've got this wind blowing, but look at your bigger levels. Look where the price has to do something. If it keeps going through, we're not done. If that's where it wants to bounce, then that's all area I'm looking at for where that may happen.
Well, I mean, I agree. And also, to be completely honest with you, the euro can go wherever the hell it wants now that our mutual friend Ryan Paisley has settled our bet and bought me lunch. I tell you what, though, I wouldn't want to be him having to pay for that rather chunky restaurant bill, but rather someone else I wouldn't want to be is Fed Chair Powell, because talk about an unenviable job at the minute.
Yeah, absolutely. And funny enough, we had Waller coming out last week to say that people shouldn't mess with central bank independence and firing people. So he's getting some backup there from his squaddies.
Also, that's Waller out of the running for the Fed chair job next year.
Exactly. He did it on purpose to rule himself out of the running. But and I'm looking at maybe Trump's going to get his way because last week, as I said, I spoke about the market looking like it had turned the corner for all the bad news, and this weekend news has just sort of confirmed that. The pendulum once again has swung, and now we're in for a period where everything is right in the world, at least in the market's eyes. However, I'm not one to look at the here and now too closely. I like to look at the future and what this actually means going forward. Now, businesses have suffered 3 to 4 months of uncertainty. That's caused sentiment to turn negative. We've seen activity slumping in things like the PMIs, but we're yet to see that in the hard data, and that's where Trump may finally get his lower rates. Because despite the market now being bullish US risk on this China deal, we may yet still see the hard data starting to turn worse, a bit softer, if only as a reaction, a lagging reaction to the sentiment and the private data that we've seen. So just when things on the trade front maybe start to look better, it's possible the US data might look like it's going to wobble just as a bit of catch up, as I say, from that sentiment and survey data. Now, that wobble might only be a blip, I think, but it's likely to give the Fed a reason to start cutting again because they still don't want rates over 4%. Now, markets tend to have goldfish memories, so it could ignore any negative blip in the data. Whereas for the last few weeks, as we know, it's just been waiting for it to roll over. So the question here is whether any weakness is temporary or whether Trump has done any irreparable damage. But either way, I think he's likely to get his wish of the Fed getting rates lower from this point onwards.
Well, I mean, you're not exactly sticking your neck on the line there. I mean, I think we all agree that the next move from the Fed is a cut. It's just a question of, does it happen in June? Does it happen in Q4? Or does it happen at the start of next year? I mean, I agree that the Fed that their next move is going to be lower. I still don't see them doing anything this time of summer. I think September at the absolute earliest for another rate cut, because there is still this huge degree of uncertainty. They are still going to want to make sure that inflation expectations are anchored at that 2% target. And I don't think they're going to have the confidence that inflation expectations haven't unanchored by the time of the next meeting, or June, or even the meeting at the back end of July. So I think this sort of wait and see stance is still appropriate. And all the time that the labour market is ticking along okay, then there's really no need for them to rush. And even if the labour market does start to weaken off, then I think they're going to focus primarily on that price stability side of the dual mandate first and foremost.
Yeah, well, I'm going to disagree slightly on that, because one thing we've heard from every central bank is that they don't know what they're going to do while this uncertainty is going on. Now, if this uncertainty is close to being resolved, i.e. all these trade deals that are going to happen over the next couple of weeks, then that removes the uncertainty. And when that happens, everyone's got to look back, well, what was the economy doing underneath the surface? The economy in the US has been softening since before Trump came in the hot seat in January. The Fed were cutting before then, so I know we've had this discussion about, whether Trump's in the mix or not, but take him out the mix. The economy was in a place, I should say, where the Fed was going to be cutting rates. So take that certainty away. Is the economy going to be looking any better? Is the European economy looking any better? Is the Bank of Canada economy looking any better, or the Canadian economy looking any better? Because they were all cutting rates. So I think if the central bank, if the Fed sees that this is potentially uncertainty being removed, then they'll get back to that. And I think maybe June is a bit too soon. But if the data, as I say, if it starts rolling over, if we get a dodgy NFP, we get the hard data now showing a lagging reaction, then certainly the market's going to get more dovish.
Well, yeah, I mean, the market's always going to run away with itself, let's be honest. We will wait and see on that one. I think, as we've mentioned before, the reaction function for other central banks in the rest of the world is a lot easier than it is for the Fed, because they're not dealing with the inflationary impulse of tariffs that the Fed may have to be dealing with. But we could talk about that one until the cows come home. Instead, we're going to talk about the Bank of England, who are, even by their own incredibly low standards, in an absolute shambles. Let's be completely honest.
I need to put my feet up for this one. Is this going to be?
I think you probably should. And I'd advise our viewers and listeners to go and make themselves a cup of tea, because I'm going to get on my high horse now. I've got to have a bit of a rant, I'm afraid, because the MPC are in a pickle. We did get a 25 basis point rate cut from the old lady last week, which took bank rate down to 4.25%, bang in line with market expectations. But everything else was a complete and utter mess, to be completely honest with you. The vote split, first of all, we only had 5 policymakers who were in favour of that 25 basis point rate cut. 2 members of the MPC, external members Dhingra and Taylor, instead wanted a larger 50 basis point cut, broadly, again, in line with expectations, especially Dhingra. She has been one of the most dovish members for quite some time now. While another 2, external member Catherine Mann and chief economist Hugh Pill, for whatever bonkers reason, wanted rates to remain unchanged. Now, quite why the chief economist wants rates to remain unchanged is one matter altogether. Catherine Mann, back in February, when she was voting for a 50 basis point cut, wanted bank rate to be 4.25%. Now she's got a chance to get bank rate to 4.25%, and all of a sudden she doesn't want it there, despite risks having increased quite considerably since then. So I don't quite understand that. You've then got those 5 who did indeed vote for a 25 basis point cut. And if you dig into the minutes of the MPC meeting, you'll find that most, which in BOE speak is usually 3 or 4, saw the decision to deliver a 25 basis point cut as, and I quote here, finely balanced. So we were very nearly in a situation where the BOE actually kept rates on hold last week, as opposed to delivering the rate cut that they've been signalling very, very strongly towards and that markets had fully discounted. Now, if that wasn't perplexing enough, you had a policy statement that was effectively, at least in terms of the forward guidance, a carbon copy of what they issued last time out, with the bank reiterating that they're going to take a gradual and careful approach to policy easing, and that policy needs to remain restrictive for sufficiently long in order to reduce the risk of persistent price pressures within the UK economy. Now, you might sit there and go, well, that's fair enough. It's very, very uncertain. Why would they want to rock the boat? Well, I tell you why they would want to rock the boat, because their latest round of economic forecast pointed to slower economic growth, higher unemployment, a lower peak in inflation, and a quicker return to the 2% inflation target, with that target now being seen in the first quarter of 2027, as opposed to the last quarter that we saw previously. So essentially what we have here is a situation where, just as the Bank of England's expectations for the economy turn more downbeat and turn more pessimistic, what do the MPC do? Well, they go and turn hawkish relative to market expectations. I mean, honestly, what the hell are they doing on Threadneedle Street? The sum total of all of this is that...
Don't ask me. Please don't ask me.
Well, I'm going to have to in a minute, because I haven't got a bloody clue at this stage. I mean, the sum total is, I think a June rate cut is almost certainly off the cards at this point. It's probably not going to be until August that they cut again. Just given the mechanics of that MPC vote, it's going to be hard to get a majority for a cut before then. But I must say that given the mounting downside economic risks that the economy continues to face, it does really feel now that this idea of gradual and careful easing is on borrowed time. And frankly, deliberately or otherwise, I think we're going to end up in a situation in August or September where the BOE yet again find themselves so far behind the curve they can barely see the damn curve, and end up having to cut much faster and in much bigger clips once the summer is out. And once again, it's an absolute mess, all of their own making.
The end. Again, I'd have to ask you the question. If you're looking at the economy right now and you're in charge of the Bank of England and you had a meeting tomorrow, what would you do? Would you be cutting rates?
Yes.
Right. So that's what I think they're going to do. I think, again, like I was saying about the Fed, we've potentially got this uncertainty removed. We've got weakening economy, although the Q1 GDP was sort of okay. So I think they're going to continue cutting. Again, whether they hold off or not, anyone's guess. But I think they should be cutting. Probably need to get rates down to 3% at a minimum, if not more. And I think continue cutting. So for me, and as a trader, I'm going to look to see whether the market maybe gets a bit too undovish over the Bank of England compared to what we see from the economy. I think we get GDP data this week as well, monthly GDP data, so that could be a turning point as well.
We do, yes. Although I would imagine that Q1 GDP number is going to be very skewed by tariff front running. I mean, we saw the surge in imports depress the US GDP number. It's going to artificially boost GDP everywhere else, because those imports have got to come from somewhere. Of course, also you need to bear in mind we've got jobs data out of the UK this week. That'll be out by the time you watch this programme. It's really not worth the paper that it's written on, although the ONS is going to be getting a new chief executive. So best of luck to whoever he or she will turn out to be, and hopefully they can right the ship that has become rather shambolic of late. But I could rant about all the economic institutions of the UK all day long. I think it's probably best I don't, and we move along.
I was going to say, right the ship. They've got more chance of raising the Titanic. But yes, we'll leave it there. We better move on quickly before I start on a rant as well.
I'm bad with each other here, aren't we?
Yeah, exactly. I'm going to get stuck into US CPI that we've got coming up this week. And as I mentioned, since this US-China trade deal news, we've seen rate cut expectations dipping for all three of the major banks, the Fed, the ECB and the BOE. At the time of this recording, markets are expecting 56 basis points of cuts, give or take, by December for the Fed. That's compared to 75 basis points on Friday. Both the BOE and the ECB are pricing less than 50 basis points of cuts by year end. Now, considering 2 weeks ago, both for the Fed and the Bank of England, we were pricing 4 cuts or 100 basis points of cuts a couple of weeks ago, just shows how fast things can change. We obviously had 1 cut from the BOE, so we've then washed out another cut at the moment. So we get the CPI data on Tuesday from the US, and that might see rate expectations flipping again. Now, I've spoken about this level before on the show. My sort of hawk dove line for the Fed has been the 3% number in the core CPI. That's a number we've been running above for the last 4 years, even while that finally dropped below 3% to 2.8% last month. And I think another dip in the core and the headline this month below that 2.8%, and that's expected this month, as is 2.4% in the headline. I think that, again, will push the Fed closer towards a cut. Now, I think the Fed would look through some potential inflation, temporary inflation coming through from all this tariff stuff, just to focus on the ongoing trend in inflation, which is coming lower. Now, obviously, we're in the same situation where we haven't got pen to paper on any trade deal, so we haven't yet got rid of all that uncertainty. And I don't expect things to go smoothly on this trade talks and stuff all the time. So perhaps be ready for some bumps along the way. But again, keep at the back of your mind where the Fed wants to go with rates, and the trading opportunities will come if the market is at odds with both the Fed and the data. So that's what I'm looking for from the CPI data this week.
Very good. Does CPI matter anymore this week, given the euphoria that seems to have overtaken everything? I know you've wasted 3 minutes of your life now going through all of that, but I'm kind of sat here going, actually, we've written off the last 2 months of economic data because it's skewed by tariffs. We've now got the April figures starting to come in, which, yes, they're going to have the effective tariffs in there, the effective trade embargo between the US and China, et cetera, et cetera. But we're now sat here in mid-May going, well, again, the policy's changed. So, do we really care?
Yeah, well, we do, because the markets will care. The markets will care. CPI comes in,
will the market be overly bothered? I'm not convinced that it's going to be a huge mover now.
I think it will, because we switch so quickly, particularly on things like rate expectations. I mean, how can you go from pricing 100 basis points of cuts for the Fed as well a couple of weeks ago to now predicting 50? Okay, and they haven't even cut once in that whole period.
Or change the language or anything.
Yeah, well, and the market's been expecting inflation from all these tariffs. So what if we get a read that's 2.2% in the headline and 2.5% in the core? The market's not going to go, oh, no, forget about that. They're going to go, well, hang on a minute. The Fed are actually getting closer to inflation now. So if, again, all this uncertainty is removed, that's going to leave inflation at 2.2%, the core at 2.5%. And that's where the Fed wanted it when they wanted to keep cutting. So, yeah, the market is going to pay attention to it. I'm going to pay attention to it. You can do what you like, mate.
I will be glued to my desk, mate. You know that. You know that very well. And I'll also be glued to my desk the UK jobs numbers tomorrow while you're fast asleep in the land of Nod somewhere. But yeah, you go on that self-imposed strike. Don't worry.
Yeah, I'm going to write a letter to whoever takes over, whatever Betsy Dog's home they get the new guy from or woman, and say put the data back to 9:30 or I'm staying on strike.
I will second that. If anyone from the ONS is watching, please go back to 9:30. Releasing economic data when the market's shut has got to be one of the most bonkers ideas that anyone's ever come up with. Anyway, we're going back to that rant about the UK, which we promised we wouldn't do. So let's move on to our plays of the day instead. Right. Let's keep things relatively simple and short and sweet this week. We're going to look at the S&P 500, and I'm going to quote my boss, the great man Chris Weston, as he often says, China's solved, get involved, which certainly seems to be the market's mantra for the time being. The S&P future trading north of all the key short, medium and long run moving averages and trading north of the 200-day moving average for the first time since late March. From a technical perspective, you'd say the bulls are back in control. From a momentum perspective, certainly remains to the upside. And also you would expect, now that we've broken those key levels, you would imagine that there are going to be some forced buyers coming back into the market as well. So rather than being the rally seller that I've been for quite some time now, it looks like dip buying is the modus operandi for financial markets once more, and for the S&P in particular, with 6,000 potentially on the cards before too long if this positivity continues, and certainly if we don't get any negative data surprises, which could be good news from a trading perspective, but bad news for me because it might mean that I have a lunch bill to settle with you, Ryan, sooner than I expected. Dollar yen for you this week.
Yep, I'm not going to comment on our bet.
I know you don't want to jinx it.
I don't want to jinx it, so no, zip lips from me. And
I was trying to lure you into it.
No chance. Not blow that one out the water. Yeah, dollar yen for me. And all this volatility, I can't do anything but try and play both sides of the coin on this one. So it's a bit hard to pick one idea, pure idea, in the midst of these market moves. So I want to look at two possible trades for dollar yen. The first is to see how far this rally can continue. And for me, the nearest area to watch is sort of from 148.80 up to 149.40. It looks good enough as a potential stretch point for this move. So that's one area I'd potentially look to try and counter trade. And it's big enough that you don't need to rush into it either. As you can see from the chart, we've got plenty up there. We've got fibs, we've got moving averages, we've got old levels. So it's a big old area to look at. So you can give it some time to see how it performs rather than trying to hit it from a first touch point of view. Now, on the other side, I think dips down to 147, maybe even 146.50 would be where I'd look to buy. We broke up through that area pretty strongly in this move, but I like to see what happens if we come back to a level that's a big level, even if it's broken easily the first time around. So any trade right now depends on the reason for why the price is moving. So I'll be less inclined to look at shorts if the US starts rubber stamping and signing some of these deals, less inclined to buy dips if everything is falling apart as it looked to be a couple of weeks ago. So always judge the reason why a price is moving.
Very good. We'll let Ryan go and sort his splinters out after the fence that he's been sat on there with his play of the day, and wrap up the show, because that does bring us to the end of another episode. Thank you very much, as always, to the indecisive Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you also to our producer, Kyriakos, as well, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, your views on everything that's going on, and whatever the hell you think might happen next in the whole tariff saga. And myself and Ryan will be back, I should say, with another show this time next week to try and make sense of what I'm sure is going to be another rocky ride over the next 4 or 5 days for financial markets. In the meantime, thank you very much as always for watching, and goodbye for now.